Welcome to TMT channel, always striving to become better traders. In this new video we will talk in less than 5 minutes about the psychological battles traders face in ever-changing markets. In many fields of performance, the learning process is continuous throughout a professional career. For example, as soon as a surgeon masters surgical techniques, new approaches appear, microsurgery, robotic surgery, that promise better results, which means that physicians are always engaged in continuing education, updating and improving their skills. Similarly, in business, consumer interests, needs and demands are constantly changing. As technology changes, what consumers wanted yesterday, high-performance cars, is very different from what they want today, electric motors, and what they will want tomorrow, AI-guided autonomous vehicles. Therefore, a successful business is always reinventing itself. Financial markets are also constantly evolving, which means that any competitive advantage in trading cannot be permanent. I recently asked to ChatGPT whether financial time series in the stock market are stationary, and the answer in part was no. Stock market time series are generally not stationary. Stationarity refers to a time series that exhibits constant statistical properties over time, such as constant mean, constant variance, and constant autocovariance structures. In the context of the stock market, prices and returns tend to exhibit non-stationary behavior. This means that the patterns exhibited by the market at one time may be very different at other times. Any trading strategy that has worked in the recent past is not guaranteed to work in the future. Volumes change as market participants change. That alters volatility and trends. Like the surgeon or the entrepreneur, the successful trader has to reinvent himself to find new sources of competitive advantage. The real challenge in financial markets is the ability to detect when markets change and identify the nature of that change. Too many traders simply label markets as directional or volatile. They make money in directional markets and lose money in volatile ones. However, a more promising view is that there are at least 3 types of markets: trending, cyclical and rotational. It is often the rotational market that appears to be volatile and impossible to trade. But if we recognize the nature of rotation, then we can trade trends and cycles in the strongest and weakest market sector. A successful approach to trading wouldn't look for trends or reversal first. It would look for stationary conditions. We would first identify what is trading meaningfully. Not 1 in 10 traders do that. They look for their types of markets and impose their meaning on what they are trading. That is fertile ground for emotional disturbances. Because markets are constantly changing, we must always be flexible. Just as a soccer team adjusts its offense to the field condition and the defense it faces. Just as a restaurant adjusts its menu to suit a new generation of young diners, we have to adjust our trading in the face of markets that sometimes operate in trends, sometimes in cycles, and sometimes on a rotational basis. An open and flexible mindset is best positioned than a positive mindset. Thanks for watching, and give us a like if you appreciate this content. Subscribe, share and comment below. Remember, don't worry, have fun trading.